Hello everyone, welcome once again to the weekly lecture videos. And in this video, I'm going to talk about the third learning objective of chapter 2. We will essentially learn about average and marginal tax rates. So let's have a little background first of all. Taxes can be one of the largest cash outflows that a farm experiences. For example, for the fiscal year 2017, Rio Tinto, one of the largest conglomerate in Australia, Rio Tinto's earnings before interest and taxes were $12.8 billion. Okay, so you understand that its tax bill, including all its taxes paid worldwide, was a whopping amount. Okay, the size of the tax bill is determined through the tax code and often amended set of rules. Okay, if the various rules of taxation seem a little bizarre or convoluted to you, keep it in mind that the tax code is the result of political, not economic forces. As a result, there is no reason for it to make economic sense all the time. The corporate tax rate in Australia is 30% and New Zealand 28% for 2018 tax year. And a concession has been made for companies in Australia with an aggregated turnover of under 25 million to a tax rate of 27.5%. Okay. Generally, corporate taxation in Australia and in New Zealand is a flat tax rate in that there is only one tax rate, and this rate is the same for all income levels. With flat tax rate, the marginal tax rate is always the same as the average tax rate. Okay, we will be discussing about this marginal and average tax rates soon. In some other countries, different tax levels apply to different level of corporate income. Now come to marginal versus average tax rates. In making financial decisions, it is frequently important to distinguish between average and marginal tax rates. Your average tax rate is your tax bill divided by your taxable income. Okay, so in other words, the percentage of your income that goes to pay taxes. On the other hand, your marginal tax rate is the extra tax you would pay if you earn $1 more. Okay, so let's see an example here. So this table shows the taxable income in the left-hand side and the applicable tax rates. Okay, so for example, you can see from 0 to 18,200 there is no tax, then 18,000 to 37,000, 19%, and the tax rate increases as the level of income increases. A somewhat similar pattern is applied in New Zealand too. Okay. Now, let's take an individual who has a taxable income of 106,000. Okay, then how we'll calculate the tax for bond. So what is the tax bill? So you can see the tax bill will be, first of all, you see that as we have seen in the last slide, up to 18,200, there's no tax. And then 18,200 to 37,000, this level has 19%. And that is, you see here, that 18,800 is 19%. Then the next chunk is 53,000, where 32.5% tax rate applies. And the last chunk is 16,000, where 37% tax rate applies. Okay, so the total tax is 26,717. So that is the total tax. Now, how do we calculate average tax rate? As I mentioned previously, this average tax rate is your total taxes divided by your taxable income. So total taxes divided by taxable income, and you can see that average tax rate is 25.2%. Marginal tax rate, on the other hand, is the tax rate that applies if you earn one additional dollar. So what is your the tax rate on your the last chunk of income, which was 37%? So that's the largest tax rate you pay. Okay, so now you have one additional dollar added to this 106,000 that income will be taxed at this highest tax rate, which is 37%, and that is your marginal tax rate. So average tax rate is 25%, 25.2%, and marginal tax rate is 37%. Now, let's learn about an imputation system. Under a classical system of tax, a firm is first taxed on its profit, and the shareholders are then taxed on any dividends that they receive from the firm. Okay, so this leads to double taxation of corporate profits, with the company profit being taxed in the hands of the company and then taxed again when any of the after-tax profits are distributed as dividends to the shareholders. Okay, so let's say a company has an income of $1,000 and the company pays a tax of $300. Okay, so that is the corporate taxes paid by the company. Now, this 700 is paid as dividend to an individual shareholder. Now, that shareholder again has to pay a tax on the 700, let's say at a rate of 10%. So that would be 70. So this is the personal taxes. Okay. So the 690 will be the net income for the individual shareholder. So this system is called double taxation. And this double taxation was removed in Australia in 1987 by introducing a new tax system, which is called imputation tax system. Okay. Now, under an imputation tax system, a company still has to pay tax on its profits. Okay, the company then advises the shareholder of the amount of company tax already paid on the dividend the shareholder receives. The shareholder then adds this amount of tax to the cash dividend that they have received and pays personal taxes on the grossed up amount. Okay. However, they also receive a tax credit, which is known as franking credit, equivalent to the amount of tax paid by the company, which they can offset against their taxable income. This effect is that the company tax is negated with the amount effectively paying tax on its profit at the average marginal rate of its shareholders. Okay, so this is the point that I just explained. Just to give you an idea once again, so as I said that the example that I gave, let's say that a company has a before tax profit of $1,000 and it pays a tax of $300, and the after tax profit is $700. Okay, now the $700 is paid to a shareholder as dividend. So what the company will do, company will pay the $700 dividend to the shareholder, and at the same time, it will advise that $300 have already been paid as tax. Okay, so the grossed up amount will be $1,000. Okay, grossed up amount will be $1,000. And let's now assume that an individual has a tax rate of 19%. So the individual will calculate the tax 19% on this grossed up amount, which is 190. Okay. Now look, the company has already paid a tax of $300. So the investor received this $300 tax credit. Now, since the tax is 190, so the investor doesn't need to pay any additional tax. Rather, the investor will receive a refund of $110. Okay. $110 of the refund an individual investor will receive. Okay, so this is an example how the imputation tax system works. Okay, so that's the end of our discussion on this learning objective. So watch the next video for our discussion on the learning objective 4 in this chapter, which is determining firm's cash flow from its financial statements. Thank you very much.